Hey everybody, welcome back to our Texas Real Estate Construction YouTube channel. In today's video, we have Dr. Jason Williams with us to talk a bit about real estate underwriting and what he does and what makes a good deal. So, Mr. Williams, pleasure to have you on tonight.
Thanks for having me. Looking
Absolutely. I
forward
know
to it.
I gave a brief introduction to a little bit about you, but if you don't mind, could you introduce yourself to your audience and what you do?
Yeah, my name is Jason Williams. I've been a real estate investor for going on 20 plus years now. Um, I started out when I was in grad school. I went to Texas Tech. Earned my PhD in chemical engineering. I was a chemical engineer for 15 years, and my dad always said, do what you want to do for your career, but make your money elsewhere. And so he used real estate as that vehicle. And so I started using vehicle as or real estate as that vehicle as well. So I started real estate investing in 2003, um, doing a lot of single families up until about 2017. And then that's when I discovered the art of using other people's money in apartment syndications. That's when I met my mentor, Joe Fairless. I don't know if y'all know him. Probably maybe heard of him. He's got like almost 3 billion of assets under management. But I've been working with him, and so that's where I really got started in like multifamily. Um, as an engineer, I always created systems. I was an R&D engineer, so I had to create systems to help the lab techs translate lab data that we took into something that the salespeople could use to sell the items that we were making. And so I tried to make it as foolproof as possible. I've made a lot of Excel macros and stuff like that so that it took like minimum input to get the result you needed. So I took all of that background into apartment underwriting so that I can like import a T12 and a rent roll into my model, and it fills out like most of everything I need almost automatically. So that's how I got into underwriting, and so that's where I am now.
Absolutely. It seems like a lot of those engineering to real estate, those habits and disciplines and principles, they really carry over.
Yeah.
Absolutely. And could you talk a bit, I know that right behind you it says ironclad underwriting. I know we spoke a little bit about the show, but if you don't mind, could you explain what under or ironclad underwriting is and how you came up with that?
Yeah, sure. So with my model that I created where I can import my T12 and stuff, a lot of people have heard of it, or I've actually helped people with their underwriting. And so people wanted to start buying my model, or they wanted me to start training them on how to use it or just how to do underwriting in general. I was in the best ever conference a couple years ago, and people just started hounding me. It's like, hey, I need help with underwriting. I had no intention of helping or teaching people how to do it, but so many people came to me asking for help that it was like, all right, well, I'll turn what I do into a course and I'll help people learn how to underwrite. And so with that spawned the ironclad underwriting or ironclad underwriting mastery is what my course is. So, and I go through all the nitty gritty of pretty much every single aspect of underwriting. I go through almost every single cell in my model so that you understand what you're putting in versus just like blindly putting numbers in and hoping the best.
Hmm.
I've met a lot of people who they get a model from somewhere. Maybe they join a mentorship program, um, but they don't really know how to use it. They might watch like an hour long course or sit through an hour long webinar, and then they're expected to be experts in it. My I've tried to work with some of those people, and they've looked at my course and like, all right, well, you have like a graduate level underwriting course, and we're just trying to get these kids like high school diplomas. Is like, but you need this to make like sound financial decisions, and so, but yeah, that's where my course came from.
I guess maybe they want more big picture as opposed to getting down into the details. Is that what it is? Or
I don't know. A lot of my clients are actually from other mentorship programs, so it's like they don't like the education they get on underwriting, and so they come to me to get a more in-depth knowledge, and plus they gain access to my model and everything too. So
Absolutely. And, I know we spoke a little bit before the show as well as, we've had a few real estate podcasts over the years. And frankly, we haven't had very many talking about underwriting specifically. So if you wouldn't mind explaining, could you tell us, what exactly an underwriter is looking for, or what exactly makes a good deal besides just profit?
so everybody says that they underwrite conservatively. Okay, those are just like blanket terms you throw out that don't really mean anything. If you truly underwrote conservatively, you wouldn't ever get any deals, because if you're accounting for all the risks that are potential, then it's like, all right, well, they're asking for like $10 million, but I can only make the numbers work at 2 million. You're not going to win any deals that way. So, really, what underwriting is, you want it to be accurate, and it's all about your risk tolerance. So everybody's risk tolerance is different. If you're in this space, you're an entrepreneur, you have the entrepreneurial mindset, you know that with risk comes reward. And so you have to see how much risk you're wanting to take on and what's the reward amount. And I tell all my students is like, I'm going to tell you what's a good deal and what's not. I'm going to go through my outline. I'm going to go through every single aspect. I'm going to show you the risks, where they are, how they play out. And if you're willing to accept those risks, you can move on. If you're not willing to accept these risks, then you might want to either fine tune your model, your business plan, or look for something else. So there's a lot of nuance going on in that. And also, as a syndicator, which you're just using other people's money, um, your risk tolerance should be different than if you are just going in as a JV, or buying a property outright on your own. Um, because if you're using the syndication model and you're going to have investors, you have to take your investors' risk tolerance into to play as well. And so, and everybody invests differently. Some some properties and business plans, you're doing like heavy rehab, you're doing a lot of renovations, and you're not even going to see a turn or any cash flow until like year 2 or 3, but you're going to see a really big upside on the back end. So some investors want to see, all right, I want to double, triple my money in 5, 7, maybe even 10 years, but I don't need the monthly cash flow. Other investors are like, well, I need the cash flow. I need at least 8% per year. And so they're going to invest differently. So they might want 8% per year, but at the end of, say, 4 years, they're only going to do like 1.8 times their money. So I mean, it all is different, and everybody invests differently. Some people just want to invest to get the tax write-off, which is a huge benefit, um, and they don't really care about anything because they just have to offset gains in other places. So
Yeah, out of
there's
curiosity, how does that work? I'm assuming that the restriction, it would be much less stringent of a process if you're not really looking at cash flow, right? Or how does that work?
what if you're just looking to get the depreciation, or
Right.
all right. So suppose I mean, you said you're a teacher.
Mhm.
Um, Suppose you've been playing the stock market with whatever investment you have, and you're really killing it in the stock market, or maybe you killed it in crypto or whatever. So you got all these funds, and you had to cash out because you had to go buy a new house or something. So now you have all these realized gains, right? That you normally wouldn't. You can take that, you can invest into real estate, and so you can gain the depreciation from the real estate and offset a lot of the earned income or the realized income that you gain from the stocks or whatever. I know a lot of doctors who are making seven figures a year, and taxes are also seven figures, and so they're like it's really hurting them. Um, I know other people who are in oil and gas who killed it last year, and they have six-figure taxes. So I mean, there's a lot of different reasons why you'd want to invest in real estate to offset a lot of those. So uh, and and granted, um, cost segregation is sort of going away. I think it's down to what 60% this year. A few years ago, it was 100%. So you can do your cost segregation, which is accelerated depreciation and bonus depreciation. So you take what would depreciate in like what is it, 5, 10, 27 years, and you condense it down into like the first year, and you can get all those tax write-offs. So now what this is, I mean, if you sell it, you're gonna have to report all of that. But if you hold it for more than 5 years, it's basically the government's giving you a loan, a zero interest loan, because you would have gotten that money over or the depreciation over 5 years or whatever.
Mm.
So that's how I look at it. It's and then there's a thing you can 1031, which allows you to move that to keep the depreciation into another asset, and you can just keep rolling it and rolling it and rolling it. So you're deferring taxes almost indefinitely. And then, as the laws are now, if you die, um, all the deferred taxes go away. You don't owe them. Your kids don't owe the taxes or anything once they inherit everything. But if you do 1031s for like 80 years, and then on the 81st year you sell everything, you are going to have to pay all of those back deferred taxes, which could be a huge chunk of change. So a lot of people, I mean, they just keep doing it and doing it into perpetuity. So
Absolutely.
there's
That's
a lot of tax benefits in real estate. So
absolutely. Yeah, that's definitely a big incentive. I know you mentioned whether you're a doctor, oil and gas, or making a sizable amount of money, you do want something to offset, to offset those taxes.
yep.
Absolutely. And out of curiosity, I'm sure you see this every day, but could you talk about maybe a few misconceptions that people have about underwriting, or maybe common mistakes that people do when underwriting?
Yeah. So one thing that I see a lot is they'll take numbers. They might get a OM or operate offering memorandum from a broker or something that has all these um, pro forma numbers that the broker thinks is viable. But the brokers suppose you're investing in Podunk, Texas, which is a really small town in Texas, 3, 4 hours away from Dallas, and the broker's from Dallas. So they're going to put in a pro forma number, which may or may not reflect what actually happens in Podunk. So what I've seen numerous times is people would blindly use those numbers, but they wouldn't ever verify them. They wouldn't use any third parties or anything else in that regard so that they can say, all right, these rent growths are reasonable in this really small town. Um, we can renovate it and bring all these units up to a certain standard, and then we can triple the rent or whatever. I've seen this, um, especially a few years ago in the DFW market, Austin market, San Antonio, where that would actually work. Maybe not so much now, but people see that and they run with those numbers, and they don't even. It's like that they trust it and not verify. So that's one thing is you have to verify everything that you're putting into it. And I said earlier that they just blindly put numbers into a model, and that's another thing that I see a lot is they get a hold of a model. They may or may not have, I think mentioned this before, gotten it from a mentorship program or something. They may have taken like a little, watched a YouTube video or something, and they're putting numbers into a model. I've seen many models where people are putting in numbers and those are basically dead cells. So you can change your LTV from 60 to 70 and absolutely nothing changes in the model. But they don't ever test it. They don't ever go through it and see, hey, what's going on. And so that is another thing that I see a lot of is people putting numbers in, not knowing what they're doing. I've seen people triple dipping on rent increases. Um, they go in and say, well, we're going to only increase rent $150 a month. So they put in the 150, but then I see it. Well, they put in another 150 on a few other tabs, a few tabs later, and they already included the 150 whenever they just put in the number. So I saw it. They triple dip like their rent increases. I'm like, you realize this is what happened, and they didn't even know. So I mean that's that was eye opening to those people whenever I was helping them with their underwriting. It's like, no, I mean, it only works if it's like that. It's like, well, you're increasing rent $450, not 150. So,
Absolutely. And are you mostly handling multifamily deals, or are there any other particular deals you're underwriting?
I help people underwrite. Right now I'm helping some clients do some ground up construction on build to rent, where they're building like a bunch of townhomes. I've helped people with RV parks, mobile home communities, self storage. I've helped people with retail, triple net, mixed use, where the ground floor of a development would be like triple net retail, and then the floors above it would be residential. So I can help people pretty much with any kind of commercial underwriting. So
Yeah, and that's in particular that's really interesting about build to rent because the construction market it was really booming. I guess some could say it's cooled off a bit, but build to sell is one thing. Build to rent, you don't often hear about that as much. Could you talk about how underwriting a build to rent is different from a build for sale?
so with a build to rent, I mean, you're building this and you're going to hold it, say, for a longer period. Um, 5, 10 years. I've seen a lot for 10 years. And so what you're going to have is you're going to have the land, or you're going to have to buy the land, and then you're going to do everything horizontal. So you are either taking out a loan or raising money to go horizontal. Horizontal is all of your like electrical and plumbing infrastructure, everything that like foundations and stuff. And then you go vertical, which is actually starting to build the buildings. So they have a bunch of different, they have typically different phases. You can do like horizontal, and then once that happens, they can do like some refinancing, or they can get some more capital, and then they'll start going vertical, which they're going to start building the structures. And all this is happening on a certain time frame. And during that time frame, you still owe taxes, you still owe insurance, you still owe a bank note if you have one, but you don't have any income coming in yet. So with build to sell, you might build one, sell it, get some capital back, and then start putting that toward others, and kind of like snowballing that way. With build to rent, it's typically done in phases where you might do like 10, 20 units, townhomes, or even buildings of a large complex. You start getting those occupied so that you start getting income in. With that, you start increasing the value of the property, which allows you to do some more refinancing. With that, then you can start going in and building more, going on to the next phase where you're going to build another 20 units or 20 buildings. And then you repeat that until you're done. And then, and with build to rent, there's a lease up period. So it's like, yeah, you have all these buildings, but then you have to lease them up. So that could take 6, 7, 12 months, and so you have to account for that in your underwriting. Um, with build to sale, I mean, it's the same thing. You have all these buildings, you have to sell them, but you're like selling it. And I've never done a build to sell, so I'm just speculating on what I've seen. Um, but you might build like three houses and you start selling one, or you build like 10 houses and you start selling them. And then as you sell them, you start building the others. So with a built to rent, I mean, you have to lease them up, and it might be a slower process just because you're still incurring all these large costs and you're bringing in rent. But in general, rent is not going to pay as much as if you sell it. But on the same time, I mean, it's more or longer game than the built to sell. So and then once all the buildings are up, and then you might sell it in like, so say it takes like 4 years to build all of them up, and then you hold it for another 6 years and sell it, and then you would sell it just as if you would just like an apartment complex, or maybe if they're townhomes or condos, you can start selling them off as condos or houses or whatever. So
Absolutely. That makes a lot of sense. Jason, is there anything you haven't said you really just like to hit home for us?
well, if you're interested in learning more about underwriting, I have a master class on my website. It's ironcladunderwriting.com/masterclass if you're interested in learning some more, where I go into the 7 red flags of underwriting that I see. I tapped on a few um just recently or here, but I go further in depth into what I see and what to look out for whenever you do underwrite. I've helped passive investors vet deals so that they would know if the deal they're going into is good or not. I've helped seasoned people who just want to improve their underwriting game, because there's always more you can learn. We have a community where I go in and we go have office hours every week where we look at live deals. What we'll analyze deals for like LPs, or we'll go through. It's like, all right, I got a rent roll in the T12, and so I'll just start working on it, and we would go into it together, just to see if the deal would work or not. I mean, they're live deals, so I mean that they are actual deals. It's not like, all right, I have a curriculum of deals that are 10 years old. It's like, no, these I just got it from a broker and now we're looking at it. So we do all that, and all this is on my website at ironcladunderwriting.com. So
Absolutely, Jason. And we'll make sure to have those links to Ironclad and then to your master class as well in the description of the video. Jason, thank you again so much. It's been great to learn a little bit about you and what you do underwriting, a few things to look out for, as well as the build to rent I thought was interesting as well. So thank you again for taking the time to join us tonight.
oh, thank you. And if you want to learn any more, like you, if you want your listeners to learn more, I'll be happy to come back and we can talk about another asset we can discuss. So,
Okay. Yeah, we'll have to chat. That sounds interesting. All right, Jason. Well,
all right,
again, thank
well,
you so
cool.
much for those of y'all out there who are interested in Jason's underwriting and learn, maybe even just want to connect with him in general. We'll have his information in the description of the video. This is Aaron signing off from Houston, Texas, and we will see y'all later.
Thanks.